Welcome back to the Daily Crypto Roundup. Today we are covering a market that feels like it is being pulled in two different directions at the same time. On one side, Bitcoin has ripped back above $72,000 as traders react to growing optimism around a Middle East ceasefire and jump back into risk. On the other side, under the surface, some of the biggest structural stories in crypto are flashing warnings. We have reports that potential buyers are circling Gemini, which tells you consolidation could be coming for weaker exchanges. We have a Trump-linked DeFi story raising major questions after Liberty Financial reportedly borrowed $75 million against its own token and left some depositors trapped on Dolomite. We have Wall Street stepping back from one of its favorite Bitcoin trades as CME futures activity drops sharply. And we have Tezos trying to push one of the more interesting real-world asset narratives we have seen in a while by tokenizing uranium, gold, and rare earth metals. So this is one of those days where the headline price action looks bullish, but the deeper read on the industry is far more complicated. This episode is brought to you by Kraken. If you want a trusted place to buy and sell crypto, check out Kraken through the link in the description. And for a limited time, if you sign up using our link, we will put 20 XRP into your new Kraken wallet. And if you want the bigger picture every single day, make sure you are following the podcast. Let's start with Bitcoin, because that is the headline everyone will see first. Bitcoin moved back above $72,000 as optimism grew around a two-week US-Iran ceasefire, with reports across financial media showing the move was tied closely to easing geopolitical tension and a broader risk-on rally. In plain English, traders saw the temperature coming down in the Middle East. Oil dropped hard, and money rotated back toward assets that benefit when fear fades. That included stocks, and it included crypto. Market coverage showed Bitcoin trading around the low 72s at the peak of the move, with Ether and other major coins also bouncing sharply. The key point here is that this rally was not really about some huge Bitcoin-specific catalyst. It was about relief. It was about markets suddenly deciding that the worst-case scenario may have been avoided, at least for now. That matters because it tells you a lot about how Bitcoin is still being treated in this cycle. For all the talk of Bitcoin as digital gold, store of value, and macro hedge, in moments like this, it still trades very much like a high beta risk asset. Fear goes down, liquidity breathes easier, oil falls, and Bitcoin jumps. That does not make the move fake, but it does mean traders need to understand what is really driving it. If this ceasefire narrative holds together and markets feel that geopolitical pressure is easing, Bitcoin can stay supported. But if that optimism cracks, if the ceasefire frays, or if traders decide they moved too far too fast, then a move like this can unwind quickly. So yes, Bitcoin above 72,000 is a bullish headline, but it is also a reminder that macro still has a huge grip on this market. Now, while Bitcoin was making the big positive headline, one of the most important structural stories of the day came from CME. Because while price is bouncing, Wall Street has actually been backing away from one of its favorite Bitcoin trades. CME Bitcoin futures activity has slumped as the basis trade unwinds and institutions appear to be stepping back. For people who do not live and breathe futures markets, the basis trade was one of the cleanest ways for big firms to make relatively low-risk returns in Bitcoin. They could buy spot exposure, often through ETFs, short CME futures against it, and collect the gap between the two. It was not flashy. It was not a wild directional bet. It was basically Wall Street using Bitcoin market structure to pull yield out of the spread. The problem now is that the trade has become much less attractive. The premium in futures has compressed. Reports suggest the annualized basis has fallen to around 5%, which is only a little above the risk-free rate. Once you factor in costs, complexity, and risk, that easy trade stops being all that attractive. And the result is that open interest and volumes on CME have dropped sharply. That is important because it means part of the institutional support people got used to in this cycle was not necessarily some giant wave of true conviction buying. A lot of it was structured arbitrage. A lot of it was funds taking advantage of a profitable setup. So when that setup weakens, the money pulls back. That does not automatically mean Bitcoin is in trouble. In some ways, a less leveraged, less arbitrage-heavy market can actually be healthier. It can mean cleaner price discovery. It can mean prices driven more by real demand than by institutions' farming spread. But it also means the market loses one source of stability and one source of size. So while retail sees Bitcoin ripping and thinks the institutions must be piling back in, part of the truth is actually the opposite. One of Wall Street's most comfortable Bitcoin trades is fading, and that changes the plumbing underneath the market even if the headline price still looks strong. The next story takes us into the exchange world, and this one is a big signal about where the industry may be heading. Potential buyers are reportedly circling Gemini, the Winklevoss-backed exchange. Now on the surface, this sounds like another M&A headline. But the reason it matters is what it says about the state of the crypto exchange business. Gemini used to be one of the cleaner, more recognizable brands in the sector. It had the institutional look, the regulatory-first image, and the backing of two of the most famous names in crypto. But over the past year, the business has been under pressure. The company cut staff earlier this year and reportedly moved to exit several overseas markets in order to focus more tightly on the US and Singapore. So when you hear that buyers are circling, the story is not just about Gemini itself. The bigger story is consolidation. In every maturing industry, there comes a point where the strongest platforms gain share. Weaker or slower growing firms become targets, and size starts to matter more than branding. Crypto is heading deeper into that phase now. We are moving out of the era where having a recognizable name and a clean interface was enough. The competition is harder. Regulation costs money. Global expansion is expensive. Product breadth matters, liquidity matters, institutional relationships matter. So if Gemini is really attracting buyer interest, it could be one of the clearest signs yet that crypto is entering a more ruthless phase where exchanges either scale up, merge, or get left behind. And this matters to you listening because exchange consolidation affects the whole industry. It affects where liquidity sits. It affects how much competition there is on fees. It affects which firms can afford to keep launching new services and chasing licenses around the world. So watch this story carefully, because if Gemini does become a live takeover target, it may not be the last exchange to face that kind of future. And in a weird way, that is both bullish and bearish. Bullish, because it shows crypto is maturing into a more serious business sector. Bearish, because it means some of the old names may not be as secure as people once thought. Now let's move into what is probably the ugliest story of the roundup, and that is the Trump-linked World Liberty Financial situation. Reports say World Liberty borrowed around $75 million in stablecoins against its own WLFI token on Dolomite, using billions of WLFI as collateral. That alone is enough to raise eyebrows. Anytime a project is borrowing real value against a token it created itself, alarm bells should ring. But the part that really made this story explode is what happened to users in the pool. Utilization reportedly got pushed so high that some depositors were effectively trapped, meaning they could not easily withdraw because the available liquidity had already been drained. This is exactly the kind of story that hurts trust in crypto. Not because crypto cannot do lending, and not because every token-backed loan is inherently bad, but because it creates the impression that insiders get to engineer value extraction while ordinary users carry the liquidity risk. That is the issue. If you are a depositor, you assume your assets are in a system with rules and risk parameters that protect the integrity of the pool. If a large borrower tied closely to the ecosystem can come in, post huge amounts of its own token, drain out stablecoins, and leave users stuck, then people naturally start asking who the system is really built for. And the political angle only makes it bigger. Anything linked to Trump already comes with extra scrutiny, extra media attention, and extra polarization. So this story goes beyond one DeFi platform. It becomes a symbol of a broader concern in crypto, which is whether decentralization is sometimes just branding layered on top of systems that still favor insiders. For the market as a whole, it is another reminder that even as the sector talks more about maturity, transparency, and institutional legitimacy, there are still episodes that feel very old-school crypto. Real liquidity gets borrowed out. Native tokens get used as the collateral base. Ordinary users find themselves on the wrong end of the structure. That is not the kind of headline the industry wants when it is trying to win back trust. Let's shift gears now into something much more forward-looking, because Tezos has made a move into one of the most interesting real-world asset stories we have seen in a while. The report here is that a Tezos ecosystem platform is moving to tokenize uranium, gold, and rare earth metals. And that matters because it pushes tokenization beyond the usual talking points. Up until now, when people talk about real-world assets in crypto, the conversation usually focuses on treasury bills, money market funds, real estate, maybe private credit, maybe tokenized cash. All of that matters, but it can feel a bit repetitive. This story is different because it ties crypto to strategic commodities, the kinds of materials that sit at the heart of energy, defense, electronics, and AI supply chains. That gives the narrative a lot more power. Uranium is not just a commodity, it is tied to the nuclear energy conversation. Rare earth metals are not just another basket of assets. They sit right in the middle of the geopolitical battle over industrial dominance, battery technology, semiconductors, and advanced manufacturing. So if crypto starts offering on-chain exposure to assets like these, it means tokenization is moving into much more strategically important parts of the real economy. That is a bigger story than Tezos itself. It is really a story about where crypto could go next if it wants to prove it has value beyond speculation. Now, that does not mean this instantly becomes a huge market. Tokenized commodities still face the usual questions. Who holds the real assets? How is redemption handled? What legal rights do token holders actually have? How liquid are these markets going to be? But from a narrative standpoint, this is strong. It is one thing to tell investors that crypto can put bonds on-chain. It is another to tell them that crypto could become a way to access the materials powering the next industrial cycle. That is why this story stands out. It feels more ambitious. It feels more connected to the world outside of crypto itself. And when you put all 5 of these stories together, the picture you get is a market that is trying to grow up while still carrying a lot of its old weaknesses. Bitcoin above 72,000 tells you risk appetite can come roaring back the second macro pressure eases. The CME futures slump tells you some of Wall Street's involvement was more opportunistic than loyal. Gemini tells you crypto is entering a tougher business phase where scale and consolidation matter more. World Liberty tells you trust can still be undermined by insider-style structures in DeFi. And Tezos tells you there is still real innovation happening in corners of the market that people may not be paying enough attention to. So the real takeaway today is this. The crypto market is bullish on the surface, but underneath it is being reshaped. Some of that reshaping is healthy. Some of it is overdue. Some of it is a warning. The traders chasing Bitcoin today are reacting to a macro relief move. The institutions stepping back from CME are reacting to disappearing easy money. Potential buyers circling Gemini are reacting to business pressure and a more competitive landscape. Tezos is reacting to the need for crypto to prove it can connect with the real economy. And World Liberty is the ugly reminder that the industry still has not fully solved its trust problem. That is why you cannot just read the price and think you know the market. You have to read the structure. You have to read the incentives. You have to read where the money is flowing, why it is flowing, and who is getting squeezed when the system gets stressed. Because right now, crypto is not moving on one story. It is moving on macro relief, institutional repositioning, business consolidation, tokenization ambition, and DeFi trust risk all at the same time. That is it for today's Daily Crypto Roundup. If you want a trusted place to buy and sell crypto, check out Kraken through the link below. And if you want the full daily breakdown, make sure you hit the podcast link in the description. Like and follow, and we will see you at the top.